Okay, good morning, everyone. This is Victoria Rutherford from Adelaide Capital. Thank you for joining me today. So today I have the CEO of Hank Payments with me, Mike Hilmer. So Hank is a financial wellness platform that serves the US consumer. They just completed their RTO a few weeks ago. They're a new listing on the TSXV venture. They trade under the symbol Hank, H-A-N-K. We're excited to have them with us today. So Mike, with that, I'm going to pass it over to you and you can run through the presentation, and then I will circle back with you when you're done and host the Q&A. If anyone has any questions as we go, just type them in the Q&A box at the bottom of your screen. At the bottom of your screen, technical difficulties over here, at the bottom of your screen, and then we'll get them answered at the end of the webinar. Okay, Mike, over to you.
Yeah, thanks for the noisy introduction, Victoria.
You're welcome.
I'll respond with a barking dog shortly. Yeah, really excited to introduce Hank to the market. Hank is a financial wellness fintech platform that we exclusively serve the US market today. And we do something really interesting. We think it's really on point given where we see interest rates and borrowing going. We automate the collection and accrual of cash from customers as they have cash. And these customers are consumers. We move it away from them until it bills to certain balances, and then we pay their bills for them. And the majority of those bills are liabilities, loans, car payments, mortgages, student loans, credit cards. And so we take all of that sort of guesswork and all of that administration away from the consumer. So consumers look at us like an automated budgeting platform. It's really a convenient service that we originally built thinking that subprime customers would be all over the platform, and that's who we tried to really introduce it to really improve their financial well-being and clean up their payments. But we found that many of our customers that I'll talk about later are really just interested in the convenience of it, because we have customers with 31 different payments on the platform, and it's a nightmare for them to manage their monthly cash. Customers pay an enrollment fee, so an upfront membership fee or enrollment fee, as well as monthly processing fees. And the more you use the platform, the higher your processing fees are. We don't lend money. We're often asked if we would lend money. We think that's risk. We don't really want to put the balance sheet on the line, but we do think there are opportunities to introduce lenders to those customers to lend money and take a fee. More than half our customers are prime quality credit. They use the platform for convenience. And the majority of our customers are actually getting out of debt quicker. We find cash in their cash flow that they didn't realize that they had. And as a consequence, they're paying loans off quicker. And that cash can be applied to high yield loans or mortgages, which are typically lower yield loans, or spread around as a customer sees fit. So we help them deleverage. And make them eligible to borrow later or at possibly lower rates. Currently, the average lifetime of customers is about 3 years. We know as we add mortgages and other longer duration loans, student loans, we're starting to see more of that those customers will stay on even longer. And so the way we sort of think about it is, there's a lot of interesting robo-advisor type of companies, looking to invest assets. We feel our job is to surface that cash flow, reduce those liabilities so those customers have investable assets. And in time, we think we'll be able to introduce those customers to robo-advisors. We're managing about 1.2 billion in liabilities today, and we expect that to grow exponentially over the next 12 months. So key highlights are, we've got really great revenue growth. We've got some announcements coming out in the next 24 hours. That will sort of give you some indications of kind of what we've done in the past, and that's with limited capital. And now we have a little capital and access to much more capital. We expect to light that up. We see opportunities over the next few years to grow the liabilities under management to approaching $40 billion or more. And again, those liabilities are auto payments, mortgages, which are typically big ticket, and many other categories. And that's an important number for us to follow, because if we're successful helping people pay off liabilities, we actually create or reduce those liabilities and build equity in their vehicle or their home then it creates refinance opportunities later that we believe we can earn fees for. We have very strong product margins. I think the margins are among the highest in the industry. I think anything over 50% is exceptional in fintech. We see a lot of companies trading at very high multiples at sub 9% margins. Our margins are 80%. And we run our operating plan very, very tightly so that we actually don't burn much cash. It's very nominal burn. And we see opportunities for many additional revenue streams, including getting paid to introduce great quality customers to lenders or deposit takers. So as we free up cash for customers, we believe we can entice them to save more money and deliver those deposits to bank balance sheets for fees, as well as to asset managers for fees. This platform's proven, in the last 3 years, we've processed over 3 million transactions. We paid off well over 800 million in liabilities for customers. That works out to roughly 7 million average daily deposits we deliver to bank partners who do the processing on the back end for us and move money. And that's about 21 million a month in payments. So, I would say that these figures are important from a stable platform perspective. We know this thing scales, which is why we wanted to take it to market when we did. And again, no balance sheet risk. So if a customer misses a payment or the money's not there when we go to debit the account for that, additional cash that we're setting aside for them, then we're not bridging them any money. We think that it would negatively affect our valuations if we were to do that. But we do think, as I said, we can introduce other lenders to help bridge that money if needed. And we're a national platform. We have customers in actually 48 states today. And so obviously our growth strategy is to deepen penetration everywhere in the US. We can grow very quickly without raising a lot of money. And I think that's a really important feature of the business. It's grown year over year with relatively low investment. We see opportunities to acquire companies that are either complementary or in the space in a smaller way, or with a specific product, or servicing one type of loan. So we know that with our currency and structured deals, that there are several opportunities for us to aggregate customers and cash flows from those fees, and more importantly, the data from those customers, which we expect to monetize into other revenue opportunities. So as Victoria said, we started trading on the TSX a few weeks ago. Very clean cap structure, very tight, only about 70 million shares outstanding, roughly 15 million free trading today. Nominal warrants, we did a financing for the IPO at about $1 a unit, which included a warrant. So roughly 3 million shares were issued for that. So fully diluted about 85 million shares, 86 million shares outstanding. So it's a pretty tight capital structure. We have a pretty good visibility on where all that stock is. And as always, management is entirely locked up. And it's very early for us. We have a very good view of where this goes over the next few years. So we're happy to be tied up. And so, why do we matter? I'll give you 15 trillion reasons. This chart, I think, says it all. Consumer debt's at an all-time high. And going into a rising rate environment, this is somewhat scary. Now, if you look at the stats, you'll see that the leverage per household is actually declining, which is not a terrible trend. Some of that may be stimulated by a lot of the COVID relief money that went into the households. So we're watching this very closely. And we're seeing sort of other trends, like used car prices are now up 20-25%. And so people are borrowing more, but having less equity in that vehicle. And because they're in negative equity, they're actually paying a much higher yield. So when yields go up, we think we'll attract even more customers, because that discovery of additional cash and the discovery of additional payments will be much more compelling to those customers. So we like, actually, when we see people in debt, we like it. And when we see a rising rate environment, we like it. And that may be counterintuitive to many fintechs. So It's a very, very interesting setup in the market. And statistically, 65% of Americans don't know what they spent last month. I don't think many people sit down and do a spreadsheet every weekend on what they spent, what their cash flow is going to look like. And I think even fewer sit down and calculate their yields and determine, what their waterfall should be. Most people just pay their liabilities based on what their lender contract says, and are just happy to get out of that loan when it's paid off. But there are so many different ways to pay those liabilities that are more accretive to the consumer. And that's what our platform brings to them. In real simple terms, I'll give a simple example here where, there's 6 or 7 different payments coming out sort of all over the place. Nothing is aligned with a consumer's payroll. So the customers, figuring out food and groceries and everything they need to get to the next payroll, phone bill, car payment, insurance, and they've got to manage this themselves. And when they sign up for Hank, we line it up with their cash flow. Typically, that's their payrolls. We have customers that use the platform for weekly debits, but most are biweekly. And we just sweep cash. And that allows us to build that balance and deal with their bills for next week. So it's a very simple, it's actually a really complicated problem when you factor in yields, when you factor in cash flow, when you factor in sitting down and trying to figure this out yourself. It's a complicated problem, but we made it sort of simple in how we run it. And it's from a convenience standpoint, I look at it pretty simply. I could cook my own meals every day, but I don't. A couple times a week, I Uber Eats, and I'm paying $3 to $6 a delivery charge. So when you look at the economics of being on the bank platform or the Hank platform, you're under $10 a month for, one loan. And it's very difficult to get to $30 a month, and $30 a month happens to be the average banking fee in North America just to have a bank account. So we think there's a lot of room for customers to pay additional fees, but also get the benefit of the platform by adding more and more payments to the platform. And that increases stickiness and that lengthens the customer duration. We go to market in a few different ways, and there are more interesting channels coming online. Automotive dealers today across the US, when they issue a loan, they recommend Hank. They explain the benefits. We're integrated with dealer management systems and menu systems, so it's a frictionless sale. About half the customers that are presented with Hank take it in the dealership, which is a pretty high percentage. So we really like that channel. And we're starting to see much larger auto groups. We announced one last week, looking at this as a really necessary product, because the issue dealers have today is, again, back to this negative equity hole caused by rising costs in used cars. They know that if they finance that Dodge Ram that might be 3 years old for 70 grand, they're probably not going to see that customer for 6 or 7 years. So, and the customer is going to pay a lot of interest. So it's really synergistic for both the customer and the dealer to get the customer on this platform so they can get back in the store sooner while that vehicle has value, by reducing the negative equity by being on this platform. And once they come in on auto, we cross-market and remarket to them, and we'll try and get a credit card, a couple of credit cards, student loans. We have doctors with multiple student loans on the platform, some in staggering amounts, from 5 different lenders that just use it to get control of their life because they're busy people. White label channels, we have a number of channels that offer some service to the customer, but they want to offer Hank as a companion product. And we like this channel strategy because we don't bear the cost of customer acquisition. We negotiate the deal. They already have customers, and they're already talking to new customers every month. So we do the processing, we provide the technology, and we help improve the financial lives of those customers. So this is a very efficient channel for us, and we expect this one to grow very, very rapidly. And in digital marketing, like many fintechs and others, through COVID, you start looking for innovative ways of adding customers. So we launched digital very, very soon after COVID struck. And it started to become a very predictable growth channel for us. We built some interesting technology to help customers get on board, understand the benefits, lots of tools and calculators so they could play around in the sandbox to sort of experience what Hank can do for them. And with some of the proceeds from our raise and cash that the company will generate, we'll be investing more in digital. It's a very profitable channel for us. And just as an example, in digital, we'll acquire a customer for about $200 all in, which includes welcome calls, the cost of Facebook or Google ads, and so forth. But we'll generate roughly $1,000 in revenue off that customer over the duration, and that's 80% margin. So, a $200 investment to generate $800 in gross margin is good math. And we think that the more we scale this, the lower those CAC costs go. As I said, some interesting demographics we're learning, and we have some great data, and we think that that's the hidden gem in this company. We have great recurring revenue, long-term visibility on that revenue and that margin and cash flow, very predictable growth. But the value of the data is very interesting to us, and it's hard to quantify until we start showing investors what the value of matching our customers with other providers are, like lenders and so forth. So we know, within our data sets, we know how many loans they have on, what their cash flow is, when they get paid, what those yields on all those loans are, what their stated payoff dates are in accordance to the loan contract, but what the stated payoff date will be on the Hank platform. And that allows us to sort of go back to that customer before anybody else knows that they may be in the market for something like a loan, and match them with somebody. And that's technology we're building now. We expect to launch that next year, and we think that'll be pretty interesting in terms of the economics it'll deliver to the business. Demographic split, 29 to 39 is our biggest demographic, but we really have an even distribution. And I think this chart says that, the entire market can benefit from Hank. We have people with multi-million-dollar mortgages on the platform. We have investors with multiple properties that use the platform to manage those property mortgage payments. So, what started as an idea that was somewhat focused on cultivating and helping fix subprime people turned into a great idea for everybody. Our processing fees are climbing, and this chart is showing processing fees per month on average per customer, climbing from $4 to, upwards of $8, $9, $10 next year. And that's just the processing fees. That excludes the enrollment fees, which are very lucrative as well. Processing fee growth is important to us because it starts to signal usage of the platform. So the more loans on the platform, the more you're going to be paying, but you're getting more benefits, so you don't mind paying. And again, this is less than a quarter pounder with cheese every month in 2022. People can afford $10 a month to be financially well and getting better. And the interest savings in most cases are significantly higher than this. So when we design product with growth in processing fees in mind, and then growth in or lengthening the duration of that customer from 3 to 4, 5, 6, and 7 years. We just launched mortgage last year in a more material way, and we'll report in the future on what that growth looks like. But we think mortgages will be 7 to 8 year customers, but we just don't have enough data on it because we've only been around doing mortgages specifically for about a year. So we think this is a really important metric, and we'll speak more about this as we report earnings going forward. And as I said, U.S. banking fees and all North American banking fees, including Canada, are about $30 a month. So that gives us an idea of where we think that ceiling is for customers. We have in the works Hank 2.0. These are some of the mock-ups of what's being developed now. A number of different features coming in here. Obviously, helping customers get financially literate by letting them understand the ratio of debt to income, how they might look to a lender, what's happening with all their payments, what's happening with how they load accounts or how we load accounts using debits, our debiting process to store and forward cash, and then signaling how their credit is improving. This credit piece actually is launching in December. And it's really important for us to show to all of our customers, but also the potential partners we're talking to, that we are able to migrate credit from, say 650 to 700 in 18 months. And we can't think of another platform that can do that so economically to make that customer eligible to borrow at a lower rate later, which creates refinance opportunities for the customer. They can pull equity out of their house, they can pull equity out of their car, or they can just refinance it at a lower rate and pay it off even faster. So we think these are really important features that will drive more and more adoption and also give us more and more marketing horsepower. As I said, I think our data is extremely valuable, and not just I, but many people we speak to. We think that the credit bureaus will be really interested in customers that are on our platform and that data, because credit bureaus are really looking for ways to help customers improve credit. And they have lots of tools that they try to offer consumers, but they don't have a tool like this to help them improve credit. And I've had conversations with many of the bureaus, and there's significant interest. And so it's important for us to aggregate more customers, which leads to more data, and strike these relationships in the future that I think can be very reciprocal, and that we can send each other customers or send each other data on an opt-in basis. Obviously, lenders will be very interested to know when people may be eligible to borrow, and we can predict that. So that's very interesting. And then the lender performance data, we find that sort of by accident, delinquencies fall for loans on our platform. They tend to perform better than loans managed by the lender themselves. And so we think that's a very good opportunity to cultivate those lender relationships, not only to help them reduce liabilities, but to send them customers. So we see very good reciprocal opportunity in the lender, bank, and all lender space. And as I talked about, developing deposits for banks and small credit unions, and picking up a piece of the overnight is also things we've talked about with various different banks, and they're all very interested in that. So our priority is really to grow that customer base organically or through transactions, so that we have meaningful business to bring to our partners, because when we go to those partners, we're also going to be asking for business. We have a very strong management team. I've been in the sector for many years, and come from lending. I built lending companies. So I have a very good understanding how lenders look at data, how they look at adjudication, what the problem in lending is right now, or what not a problem, but what emerging trends could lead to. Our CFO, exceptionally strong finance guy, transaction oriented, was vice president of Macquarie Capital. And Bill Holland, our CTO, has worked within the U.S. banking system extensively in technology. Bill joined in May and has been taking care of the expedited technology rollouts. Chris Ciccolini is running corporate development, which is finding transactions, acquisitions, and working on some of the larger scale opportunities with some of the strategic partners. Meg Howell runs all our dealer relationships, some of the smaller channels, and all customer engagement and remarketing. So he has a very busy team. And our head of treasury, Daniel, Harvard grad, super smart guy. The back end of this platform is extremely complicated, but Dan has a way of making it look easy and make sure that we do things by the book, so we pass all our bank audits. Also a very strong board, and we'll be adding to this board over the next 12 months. Myself, but also Tamara Payton, who sits on the board of a bank here in Toronto. Tim Farley out of California has been very active in the private equity and VC space. Jason Ewart is our head of capital markets and runs our investment bank relationships and so forth. For now, we feel a small board allows us to go quickly, but we do see opportunities and interests with other very seasoned board members that can put fuel into the company, and we'll be announcing as we make those decisions. And that's Hank.
Thanks so much. So that was a great presentation. I just want to remind everyone that there is a Q&A at the bottom of the screen if you do have any questions, and then we'll get to them. But I just wanted to start, I guess, Mike, can you just give a little bit more background on, how Hank came to be, and then when you got involved with the company?
Well, I had left the lending space and looked for opportunities to develop a platform on the other side of the customer's balance sheet, and just to build a pure play fintech versus a lender, because I felt like the lenders are pretty crowded. So I was introduced to various other parties and people with great banking experience, people with great compliance experience in the space, and we put together the platform. That's Hank, and that's about three years ago or so.
And then just in terms of the competitive environment, I've seen a bunch of financial wellness programs out there, but they seem to be more, education, coaching, budgeting. So on the actual payment side, who do you guys run up against when you guys are out there, talking to auto dealers and I guess looking at acquisitions as well?
So yeah, we see sort of the same sort of coaching platforms. And, I look at those platforms. We've talked to a lot of them about partnering, and I think there's some really strong opportunities to take the coaching and turn it into an actively managed service for the consumer, because it's like working out. I have much better workouts with a trainer than I do myself, and that just goes for everything. It's great if you have somebody doing it for you and pushing you. So those so-called competitors are, I think, great partnership opportunities. And the other competitors we see in this space, there's no big dominant player in this space. There are a number of sort of state-based players, and we're looking at those as transactions. We think our platform is stronger. It's more extensible. We have a bigger footprint, national footprint, and we have a very strong vision of what to do with the data. So, anybody that is doing this in the space and in, say, a small way, we see as opportunities to acquire, and we've been in touch with many of them.
And I know that you mentioned that you are the only player that can operate nationally. And so how hard would it be for one of, these state constrained players to come in and try to build that same banking relationship or be able to replicate the ability to operate, all over the USA and grow that way?
Yeah, if they have good operating history and sort of no CFPB regulatory fines or any sort of blemishes, then I'm not going to say that you can't get a banking relationship or multiple banking relationships, because you can. But banks want to make money, and they don't want to take too much risk. So it's sort of a chicken and the egg. If you want to enter into this space, you have to show that you are very low risk, highly compliant, and can deliver enough customers and processing to make it worthwhile for the bank to partner with you. And so, in some ways, without the bank, you can't deliver those things. And so you start with a money transmission license, or you just start within a state. Then you have to go raise capital, and it's sort of a long road. And so that's behind us. So we feel like we're out in front, and we feel we're the exit for guys that are in the space, as I said. But we don't see many fintechs focused on this. We see the majority of fintechs that are talking about getting financially well. When you really peel the onion, the story is somewhat, borrow your way to financial freedom. So here's a free credit report. Now I know everything about you. I'm going to give you a lower cost loan. But I'm not sort of looking at you entirely and helping you get well, right? So it's on the consumer to sort of say, sign up for some coaching and some other things to sort of get well. So, we think those are all partnership opportunities. I think we're fairly innocuous. Like I said, we love to partner with lenders. We love to take the lender declines. And there's a staggering number of declines every month in America, millions of declines for people looking to get loans. Mm-hmm. And we have a pretty good idea where those are. We see that as an opportunity to put those customers on the platform, even though they're not borrowing, but they do have one or two loans, and help clean them up over 12 to 16 months, then make them eligible to borrow and feed them back into the lender ecosystem later, which will help their future originations. So, we feel we have a bit of a Swiss Army knife here, and we can help a lot of the constituents. We don't think we're that threatening to any competitors. We're actually more complementary.
Okay, I'm going to jump over to some audience questions that have come in. There's 3 of them here that are just asking for kind of some more clarity on the Hank platform. So I'm just going to read them out to you. and then you can answer. So the first one is, do you initiate refinancing discussions with customers? For example, you can save X dollars per month or pay off your loan faster if you do this.
Yeah, there's multiple ways customers or multiple reasons customers use the platform. Some do when you run the calculators, it spells out some pretty significant savings for them. And that for those customers is what interests them. Other customers with just too many payments to manage simply use it for convenience. And so there's just multiple reasons that customers use the platform. We don't offer them financing. We're not marketing as a finance company to introduce them to anybody today. We're simply offering to automate their payments, clean up their cash flow, add some predictability to their life, and provide them sort of statements as to what their performance looks like, including the credit reports I talked about, so they can just see how they're evolving over time. And other products we bring them later will make those introductions.
Okay, so I feel like you just kind of answered their second question too, which was, do you recommend different credit card providers or use of a no-cost bank or credit union to save money? But it sounds like right now you're not really.
Well, that's the position we want to be in. We think at this stage, it's important to aggregate customers and aggregate that data because there's a lot of insights in data. And so we want to make sure that we've amassed enough data, and I think we'll be there in 6 to 8 months, where we can start matching, and we do see other products that do that, and it's sort of easy for us to create those opportunities and take a fee to do that. So it's on the horizon. It's not something we're doing today.
Okay. You said that loans on your platform have lower delinquencies. Could you please provide just some more color on this?
Sure. We track delinquencies by lender. So we know late payments by lender, obviously, because we're touching that customer. And then for there are certain lenders that report their delinquencies, and we match and look at those delinquencies relative to what we see in the late payments within our portfolio. And then we compare that to what the originators of those customers tell us as well. And so we know in auto in particular, delinquencies are roughly 50% of what the market is. And to be frank, I started going and beating my chest with lenders 2 years ago saying, hey, look, we can really help with delinquencies. But that really wasn't the headline with lenders. And I don't think that's a big headline with lenders today. It will be as these rates continue to climb and this negative equity issue in auto becomes more prominent. What they're really interested in is more loans from other sources. And so because they're all competing for that same customer. And so if we can bring them a customer that looks completely unique relative to their digital marketing and all the other origination channels, we think their look-to-book percentage will be much better, meaning they'll close more business from a better quality customer. And so that's what we think a real big opportunity is. And that can go for credit cards, it can be credit cards, student loans, consolidation loans, whatever the case may be. All of those lenders incur a cost to acquire that customer. So we're saying, well, pay us that cost, which is typically BIPs attached to the total value of the advanced capital. And we'll try and deliver you a better customer. And that's all going to be done with opt-ins where the customer says, hey, look, we trigger a customer and say, you're 6 months from paying off your loan. Would you like some introductions now? How many lenders would you like to talk to? Click 5, okay. So, okay, if we send them this data, yes, click. And then the API will send the data out to the lenders and they'll get adjudicated.
And then how do you replicate the success that you guys have had in the auto industry into other payment categories?
More strategic partnerships. I mean, auto will continue to grow because everybody has a car. I mean, that's the reality. And studies have been done that say people will pay their car before they actually pay their housing because they need to get to work and they can't afford to lose that car and take the bus and extend their drive 3 hours. But there are multiple other avenues just to get into the auto or the vehicle loan that we're sort of moving into, which would complement the dealer. And I don't want to get into sort of some of the caramel secret here. You'll just have to follow the story. But at the same time, the average auto loan balance on our platform now is about $20,000, which would have been down from the original balance. So that's a weighted average. And the average mortgage balance on our platform is about $250,000 to $300,000. So in theory, we could add a lot more auto customers, but our liabilities under management will grow exponentially by adding fewer mortgage customers and then cross-selling them to get both of those products onto our platform. So it's very difficult for us to sort of call out what that percentage mix will be over time. Okay. It's important to say that, look, there's a lot of cars out there and there's a lot of opportunity still in auto. We think we're just barely scratching the surface, and there's massive opportunity in mortgage and recreational vehicles. Rec vehicles are sort of last year, COVID drove a lot of purchases there as well. I mean, people bought small, second houses, beach houses, and RVs because they realized they didn't have to work from home. And an RV loan can be 10 to 25 years. And we really like that product, and we'll be looking for opportunities to get into that sector.
And then another audience question. So what percentage of Hank's revenue is recurring revenue?
We report under IFRS 15. It's complicated accounting. So our enrollment fee, and I think that's a good question because it allows me to clarify. Our enrollment fee is amortized over the life of the customer, which is, let's say, 3 years. So let's say the enrollment fee is, $10 a month. And then the processing fee is about $6 to $7 a month. If you only have one loan, it can be much larger. But let's just use those as numbers. So it's almost sort of 50-50 in terms of revenue recognized over time. The cash flow from the processing fee comes into us in the first 12 months. So we have a very efficient balance sheet because we insert that enrollment fee into the matrix or the waterfall of liabilities being paid. And once the customer's liability has been paid, we take a piece of our enrollment fee. So we get that money back. We get that money every month, and that sets up as a deferred revenue or a contract liability. So it looks like a liability on the balance sheet. Then it instantly turns into AR in the month we're going to recognize it, and then it turns into revenue. So it in some ways, it sort of makes this income statement difficult to look at. And I always go to Salesforce as an example. Salesforce for years, and I happen to be old and I used to trade Salesforce stock quite a bit, but for years they didn't talk about revenue. They talked about bookings and their balance sheet. And their contingent liabilities grew like crazy to billions. And contingent liabilities are future revenue that's going to come through the books. In our balance sheet, contingent liabilities are only the enrollment fee balance still to be earned through the income statement. What's not on the balance sheet, because we can't book it under IFRS 15, is the value of the processing fee revenue. The processing fee revenue is significant, and it has significant value over time, but we can't put that on the balance sheet because we actually do month-to-month contracts with our customer. If we had a loan contract that had a defined term and a penalty to get out, then we could book all of that onto our balance sheet as an asset. So a big percentage of our revenue, it just continues to come through, comes through as cash flow as well. And frankly, that caused the business to be very resilient during COVID, because we could count on hundreds and hundreds of thousands of dollars a month just coming through the business, regardless of what we invested in sales. And that might be a non-answer, but in our statements that'll be filed shortly, there's some more clarity as to what the interplay with the accounting is. I might give you a bit of a better story, because in theory, you can lose money on an income statement and generate cash flow, right? And that's what the Salesforce SaaS model does. You invest, you're reporting according to GAAP or IFRS, but the cash flow builds. And I think as you watch us do transactions and work on very interesting things and grow, you'll start to see the backlog of cash will just start piling up. So it's very efficient, which means we don't have to go to the market and down the line and further dilute to cover the operating cash flow of the company.
Okay, well, thank you for clarifying that, because the statements are coming, I think, really soon. So that will probably help a lot of people trying to read them.
They're confusing.
Another question that came in was, in light of all the recent data breaches, what have you guys done security-wise? Yeah,
we have a very secure environment. I mean, we host in 2 redundant operations, and we're actually commencing a security audit, because we recognize as we start doing transactions, and I have a fair bit of experience with what's called PCI certification. PCI certification is what the credit card companies force you to get if you're doing anything with customer data. And so we just actually started this week bringing in a third party to do the baselining of our environment, and then you fill the gaps with advancements in your technology and security procedures. And then you get audited every year. So we're commencing that now, and that's going to be a regular part of our process.
And then just on the revenue growth side, what you guys have done to date has been pretty exceptional. So I guess, what do you see going forward and being able to keep up with the same type of trajectory?
I'd be disappointed if it was only that trajectory, to be honest with you. We have a lot of big stuff planned, and I'd love to talk to you about it. I would just really encourage you to follow this ticker. Watch for news tonight and tomorrow, and throughout November. We are, fortunately, we had the RTO occurred, and now we have the ability to close on a number of the things that we've been working on. So I think you'll see much better growth.
And then just quickly, I had two last questions that came in. Who did your RTO? Who took you guys public?
Cantor was lead, Cantor Fitzgerald.
Okay. And then how much does management own?
I think roughly 25%, maybe a little bit more with RSUs and options.
Okay, wow, that's great. Well, those are all the questions. So I really appreciate you coming in and chatting with us today. Do you have any kind of final words that you'd like to leave the audience with?
Well, I think, as I said, you want to follow this ticker pretty closely and almost immediately. And I think if you like, if you followed some of these other companies like Mogo and Payfair, and you see what they've been able to do at a relatively low margin, and some of these U.S. institutional platforms, I think you'll really like this, because it's not lending, and the lending platforms are just exploding right now in a good way. They're growing like crazy. You can finance baseball tickets and NASCAR tickets if you want in 4 easy payments. And all of that lending we see is really good for us. We'll just take a little bit of fee off every one of those loans. That's our objective. And we think it's interesting that retail investors can get access to a story that would normally be funded by VCs and NPEs and then brought out to market much later. And so this is, I think, a unique situation for people to get exposure to this kind of a platform.
Yeah, it's definitely interesting. When you guys, first talked to us, I hadn't heard a story like this. We were really excited to, work with you guys and showcase you and put you out to our network. So we would definitely agree. If anyone has any follow-up questions or, wants more information from Mike, feel free to message Adelaide Capital, or you can message me. I'm sure that you guys have, some contact information on their press releases that are coming out as well. But definitely be in touch with us. And we look forward to seeing what you guys put out over the next few weeks and months.
Yeah,
that we'll definitely be watching the story.
Thank you all.
Thanks so much.